Let's talk more about today's final hour surge and where the markets go in June. Joining us here on the desk, a CNBC contributor, Peter Boockvar, of course, with the Bleakley Financial Group. It's great to see you, Pete. Welcome back.
Thanks.
What'd you make it to the close today? You think that was a material move?
Month-end noise, yeah. I would say. I think we tested the 50-day around. So I don't really look too much into it to think that there's some reason for it. I think we're trading in this range. And I think what the Fed will do, what the unemployment number next Friday will do, because I actually think that the unemployment rate becomes as important as the inflation data in terms of moving the needle on what the Fed may do. Because if you see a 4 print in the unemployment rate next Friday, then the Fed's going to all of a sudden think that maybe July could be a possibility, because I don't think if it's July, they're waiting till December.
Even participation rate stuff, though? I mean, because the unemployment headline rate is something that not only has a lot of politics attached to it, it really has participation in the labor force attached to it. So aren't they looking through that?
Well, that's why a 3.9% unemployment rate where we are now is the highest in 2.5 years, but historically very low. But it's the trajectory that they're focused on, because that's what tips you into a recession, is the trajectory of a move in the unemployment rate.
So today we had real consumption down 1/10 in services, down 0.4 in goods. We had a Chicago PMI number that was 35. Do you think we're rewriting the story here about growth?
I've never seen a more mixed and uneven economy than I've seen right now. For every good story, I can tell you a bad one. And all you have to do is just look at all the earnings conference calls from yesterday, which I do, and there's an extraordinary amount of bifurcation. To me, from what I read, what I see, all the stats I look at, this feels like a 1.5% type economy, not a 3. And I think the first quarter GDP number, which we saw, is more reality than the 2.5 to 3 that some of the estimates still remain at for Q2.
And a lot of those got rewritten today, right? Atlanta came down.
In response to that retail sales number, that personal spending number, and the trade number yesterday.
So, Peter, when you look at the ECB and the BOE, and when you look at the BOC, they're all ready to start cutting. I think we live in a world economy versus the U.S. economy. How long will the Fed wait if the rest of the world is cutting for them to start?
The Fed wants to join the party. They're feeling that peer pressure. But if you look at Jay Powell and you put your feet into his shoes, he does not want to see inflation ramp up again. He sees commodity prices. He sees shipping costs that are now inflecting higher again. He doesn't want to be in a position where he tweaks with rates, he messes around, and then all of a sudden, back half of the year, inflation goes up again. However, if that unemployment rate is 4% or more, the pressure is going to get really intense for him to cut.
So let's say that's the case. You see a 4 handle. That's kind of a new territory. We haven't been in a while. So let's say he does cut 25, let's say. Does that really make a difference?
It's noise. We're not going back to zero. It's total noise. It's going to have no impact on the economy. You know, on the term restrictive, which everyone now has their own interpretation, it's restricted for those that have debt coming due. But a 25 basis point rate cut is not going to do anything. And in fact, if they cut the short end by 25 basis points and the market thinks that the Fed's backing off from their inflation fight, I think the 10-year yield goes up. And what real estate person does that help?
Well, let me ask you a little bit about bonds this week then, because it was also a fascinating week between very weak Treasury auctions, a dynamic that, you know, nobody cares about any of our politics here, so there's been a lot of political stuff over the last 24 hours. But I would make an argument that no matter what administration we have in the fall, it's deficit negative. And the market's telling us something in terms of long-term rates came in a little bit, but that trend, by the way, this year, just this year's trend, let alone the one from July of 2000, is higher on the long end. So I'm just curious your thoughts there.
Higher for longer is not just a cliche, it's real. And at least the back end of the curve, that 4.5% level, yeah, there's a major imbalance. I mean, those auctions, as you mentioned, were poor. Not mediocre, they were poor, outright poor. And the only thing that saved them was the back-end data that reduced GDP estimates. But that's going to be a struggle in the next couple of years. I mean, a budget deficit as a percent of GDP at 6% with a 3.9% unemployment rate is trouble, especially if the unemployment rate starts to tick higher and tax receipts start to falter. Then you're going to go towards higher single digits to 10%.